the owner financing option of becoming homeowners. Okay, so what will the buyer actually gain, or what are some things that could be beneficial to them if their only option was to go through the sellers or the owner financing option of becoming homeowners? So the first thing that a buyer can be advantageous or beneficial to the buyer is going to be easy qualification. So it's easier for them to qualify for owner financing if they are unable to meet the criteria of what the bank or the traditional lender needs. Maybe it could be something like, hey, they are self-employed, but maybe they unable to actually bring up all this documentation to prove that they are self-employed, or maybe they don't have enough, their credit is not up to what is expected, or they currently are having a bad credit, but at that point in time they are really wanting to buy a house. They might have the money, but just because they have bad credit could be a problem, right? And it makes them not able to qualify for a better option in the mortgage. So they decide that, hey, why not just try owners financing? So something like that could be of benefits to them if they are unable to actually qualify for the traditional mortgage from the onset. So the second thing is going to be flexible terms. So the seller and the buyer actually can negotiate on these things, right? So they can negotiate the terms of the contract, including the rent payment, the mortgage payment, the purchase price, interest, all those things, right? How much time or length of payment that they have, duration, right? How much time they actually have to be able to make up all this payment. So it's easier to negotiate those things with your seller slash lender, because of course they are the ones financing it and they are equally the ones selling the house, so it's easier for you to do those negotiations with them by yourself. Okay, so the number 3 advantage for the buyer is going to be potential lower closing costs. So you might not have to pay for lenders fee, all other fees that is going to be in a typical bank, maybe origination fee and all other fees, right? You might not be required to pay for those things. You might equally not be required to pay for mortgage lenders and charges that banks are going to actually let you know, hey, you have to pay all these other fees. So if you are not going to pay those fees, then of course you're not supposed to bring a lot of money to the closing table. So that means it's gonna be less cheaper to close on a house when you actually go by owner's financing rather than actually going through the bank or mortgage lender or a credit union. Okay, so it could be advantageous to you. So just make sure you know the terms, right? You guys agree upon all these things before you go into contract, because if you agree on it and you see that it's gonna be less cheaper to you, why not? You can give it a try. So number 4 is going to be faster closing. So you can easily close on this house, especially if you're somebody looking for a quick close. Then you can actually choose the option of owner financing. Why? Because they really don't need to do the underwriting process, the approval process, and all those things. So even though you are going to be required to provide some things, but however, you really don't have to. They don't go through the underwriting process. It doesn't know. I don't know how long it's gonna take, but however, even if they do those things, they do your credit check. It doesn't take forever, right? It's very quick to get back your information. They can actually just pull out you give your employment history and all those things, right? So it's easier because the lengthy process of underwriting, approval, and other things is gonna be cut short. Okay, so you're going to have to be able to close faster. And other things like inspection and appraisers You can do it, but however, it's not gonna be so much of a lengthy period, and all those other times that they have to actually tell you. But after you have this duration of time to do your inspection, you have this duration of time to do your appraisal, you have this duration of time to for the seller to actually go ahead and fix all those things if something actually happened on, if the inspection report didn't come out perfect, right? So all those things can be cut short, and they don't have to give you those times that would normally have to be given to both the buyer and the seller when it comes to a traditional mortgage. Okay, number 5 is going to be building equity. So it's easy for you to build equity, right? Just like you're going to be building equity when you buy a house through a traditional mortgage, as long as you make your monthly payments toward that house, of course, yes, you're still going to be building equity just like any other person. So don't be scared that you're not going to have equity at the end of the day. The only reason why you might not have it is if you're not making those payments, and if at the end of the day you end up not owning the house, right? Because you failed to make all those other payments or failed to pay the house in full. Yeah, and it was taken away from you. Other than that, if you keep and you're consistent in making payments and you end up paying in full, why not? You're going to gain the equity at the end of the day. So number 6 is going to be non-mortgage insurance. You know, sometimes you actually end up paying this mortgage insurance, which is called private mortgage insurance, like PMI. Reason being that maybe when you actually choose your loan type, you were unable to make the actual down payment that was asked of you, right? So let's say, for example, for a conventional, you have to make a 20% down, and you were unable to make up to 20% down. What do you think is going to happen? That's you, and you could actually make some payments, right? But however, you are going to end up paying what is called PMI, or private mortgage insurance, till you're able to make up that 20% down payment. However, so even if, remember, everything is negotiable in owner's financing, so you really don't have to pay this mortgage insurance. Okay, and yeah, it's advantageous, right? So this number 7 thing is the ownership benefits. So you, even though you don't get the title, but you still have ownership over this property. Okay, so it includes the property appreciation and the ability to make any property improvements if you want to, and any modifications to the house. But keep in mind, if you're doing all these modifications and improvements, you should be ready to pay for that house until you finish the money, or until you become the homeowner. Okay, don't do all these things and then you fail to pay your normal payments every month, or at some way you forfeit or you default on these things, right? You're not going to be able to get back every improvement you made on the house. So just make sure, if you choose to do these things, keep in mind that you are not currently the owner, and it might be difficult for you if you end up going through foreclosure, right? There's no way you can get all those improvements that you made on the house out of it, right? So just keep in mind that. Number 8 is going to be negotiable down payment. So remember, I said a lot of things can be negotiated when it comes to owner financing. So you can actually negotiate a down payment as well with your sellers/lender. So it's easy to negotiate a down payment, even though you can still try to do that right in traditional. But however, it's going to be easier for you to negotiate it because the seller might be open to you doing that and paying lesser cash upfront. Or even maybe even if you say you don't have it, even if you guys agree, they might be so lenient to get a part of it and a part of it later. I'm just saying. But however, it's way easier to negotiate this down payments when it comes to owner financing. And the last thing, which is going to be number 9, is going to be potential for credit improvement. So if you weren't able to actually get a traditional mortgage just because you were not able to have, you didn't have good credit at that time, or your credit was a little lower or bad, well, these payments that you are actually going to be making on this house can actually be put into your credit, and it can build your credit over time. And however, even if the payments don't build your credit over time, you might as well as that time be working on your credit, even though you already own the house, right? So doing other things, or maybe even, remember there are a lot of apps out there that you can put maybe stuff like your rent and other payments that you make, right, to build your credit. So you could put stuff like that, your rent, your utilities, your stuff that makes up your credit, right? So you can use this time to build your credit. And who knows, maybe after you're done buying this house, you can decide to do something better, and by that time you will get a better credit, and you can actually do some other type of investment that requires good credit. Okay, and this brings us to the end of this video. Remember, my videos are for educational purpose only. Do your own research and ask questions to whoever you think is a professional that can help you with some of these contracts. Please do not forget to subscribe to my channel if you haven't done so. Like, share, and leave comments if you want us to talk about something, or you just enjoy watching my videos. That equally helps me learn as well. You know, even though we come out here and we give, we educate, we ourselves equally learn, right? So I don't mind someone leaving any comment that's gonna be of help to me as well. So thank you, thank you, thank you. And if you're interested in learning more about Home Buyers Guide, I'm gonna leave a link in the description so you can just click on the book and get to read more. Thank you. Stay safe and healthy. Until next time.